You've been contributing to your 401k for years. You've followed all the rules. You diversified like a champ, maybe even bragged about your target date fund at a dinner party once. But here's what nobody tells you. Your 401k is way more complicated and more fragile than you think. Today, we're going to go through 9 truths about your 401k that most people don't know, some of which might save you thousands in taxes or protect your family from a financial mess they never saw coming. And I get it, this stuff sounds dry, but when you see how easily good intentions turn into costly mistakes, you realize this isn't about account types, it's about peace of mind. So I'll start with one that catches people off guard, even folks with a polished estate plan and a fancy binder. And I'll do all that after I quickly introduce myself. Thanks for stopping by the Retirement Guide channel. I help people plan for and hopefully enjoy retirement. Hopefully. Let's kick things off with some breaking news. If your will says one thing and your 401k beneficiary form says something else, guess who wins? The beneficiary form wins. But I paid $2,000, $5,000, $10,000 to my lawyer. Yeah, it doesn't matter. And according to a 2020 Vanguard study, more than 25% of retirement account types had outdated or incorrect beneficiaries listed. And among married participants, 13% had no primary beneficiary listed. Sounds like a great marriage. And it's not that this is just sloppy. It's a fast track to probate court. And it's not just ex-spouses or estranged cousins. This can mean your current spouse, your kids, or your estate plan gets completely bypassed. Courts have consistently ruled the name on the form gets the money regardless of your will, your trust, or your last wishes. So here's a SECURiMENT tip. Check your beneficiary forms every couple of years or after any major life event. Do it today if it's been a while. I recently found out my mistress was listed on a few of my retirement accounts. Awkward. I'm kidding. Everyone knows Joe was the first girl and frankly, only girl who ever talked to me. So I married her. I'm an open book. Okay, let's keep going. Most people know this one. Withdraw before age 59 and a half, and you'll likely get hit with a 10% early withdrawal penalty, plus income tax. But here's what most people don't know. If you leave your job at age 55 or later, you can take a penalty-free withdrawal from that specific 401k. It's called the rule of 55, and it can be a real lifesaver if you're retiring early. Here's the catch. If you roll that 401k into an IRA after you leave, you lose that option. Now you're going back to waiting until 59 and a half. And according to the IRS, this provision is one of the most overlooked early access strategies, and it can make a big difference for people retiring early. SECURiMENT tip. If there's any chance you'll need access to that money in your late 50s, don't rush to consolidate. Keep it in the 401k until you're sure. I know someone who rolled everything into an IRA at 56, then 6 months later needed $30,000. The penalty was not fun. The look on his face? Even less fun. Most people know the standard contribution limits, $23,000 a year or $30,500 if you're over 50. But here's what they don't know. Some plans allow after-tax distributions that can bring your total up to $80,000 per year, including employer match. Yes, you heard that right. And that opens the door to a strategy called the mega backdoor Roth, where you make after-tax contributions and convert them to a Roth while you're still working. Fidelity says only about 15% of plans allow it, but if yours does, it's one of the most powerful wealth building moves you can make. And here's a little secret. Most HR departments, they don't advertise this stuff. You have to dig through your plan summary or ask them directly. SECURiMENT tip. Ask your HR rep if your plan allows after-tax contributions and in-service Roth rollovers. If they look confused, you might be the first person who's ever asked them, but that doesn't mean it's not available. This one surprises people all the time. If your plan allows in-plan Roth conversions, you can move money from the traditional 401k into the Roth side while you're still working. Yeah, you'll pay tax now, but the money grows tax-free forever. And that's especially smart if you're in a lower income year or you want to lock in today's tax rates. According to the Plan Sponsor Council of America, big fans of excitement, about 75% of large employers now offer in-plan Roth conversion features, yet most employees have no idea they can use it, let alone use it strategically over time. Here's a SECURiMENT tip. Check if your plan offers this. If you're in a low tax year or expect higher taxes in retirement, it could be a smart move. Should you do a Roth conversion? It's a great question. And the answer is it depends. So if you want real help with strategy, the strategy side of your retirement, but don't want to be sold something, we should talk. No asset transfers, no hidden agendas, just planning for a flat fee. I call it a SECURiMENT review, and you can learn more at theretirementguide.com. Commercial over. Speaking of high pressure, Have you ever been in a bind and taken a loan from your 401k? It feels deceptively simple. A few clicks, no credit check, and boom, instant money. It's like financial fast food. Convenient, but you'll probably regret it later. And here's the fifth truth that many people find out the hard way. If you leave your job, whether you jump or get pushed, the loan balance is usually due in full and fast. If you can't pay it back, the IRS treats the unpaid balance as a taxable distribution, and if you're under 59 and a half, you'll also get hit with a 10% penalty. So now you got income tax, a penalty, and less money in your retirement account, a triple whammy of sorts. The National Bureau of Economic Research found that nearly 1 in 5 401k loans end in default, usually after a job change. And here's the real gut punch. Many people take the loan assuming their job is secure. Then life happens, layoffs, mergers, burnout, the stuff that wasn't part of the plan. So the SECURiMENT tip is don't take a 401k loan unless you've got a realistic backup plan to repay it, even if your employment changes. It may be smarter to explore other short-term options. And speaking of job changes, here's a mistake that doesn't feel like a mistake until years later. If you've had few employers over the years, and most people have, there's a decent chance that you left a 401k behind, maybe even 2 or 3. Truth number 6 is old 401ks can get lost and still cost you. A 2023 study by Capitalist found that over 29 million forgotten 401ks exist, with $1.65 trillion just sitting around. That's not just a statistic, it's likely somebody you know, maybe even you. I had a client, we can call her Susan, who thought that she had 2 accounts, but it turns out she had 5 accounts, one of them from a job 15 years ago, and that account had nearly $90,000. But it was invested in funds charging a 1.7% expense ratio, way higher than her other accounts. She had no clue. So once we tracked it all down and consolidated, she cut her fees, improved returns, and most importantly, had a clear picture of her full retirement situation. And that's the real danger, not knowing where all your money is. It's hard to make smart decisions when you don't have the full picture. Here's a SECURiMENT tip. Use your old Social Security earnings record to map out your work history. You can contact former employers, you can check your old plan providers, and you can be reunited with your money. Then consider consolidating accounts where appropriate so your plan is as coordinated as your effort. Truth number 7 is sneaky. If you're planning to retire mid-year, there's a rule most people miss. You can only contribute to a 401k based on earned income, meaning wages, not rental income, not Social Security, not dividends, just paychecks. So if you retire in, let's say, March, and only earn $25,000 for the year, you can't contribute more than that. You can miss out on thousands in potential tax deferred or Roth contributions unless you front load. So let me give you an example. I had a client who planned to retire in early April. In previous years, he contributed steadily across all 12 months, but in that final year, he only got in a fraction of his usual amount because he hadn't increased his contribution rate early enough. That's money that could have compounded for decades, especially if you're over 50 and eligible for catch-up contributions. Missing a few months of opportunity in that final stretch can quietly cost you a lot of money over time. So here's your SECURiMENT tip. If you're planning to retire mid-year, don't wait. Talk to HR now. Adjust your contribution rate to front load your 401k savings while you're still earning. Truth number 8 is more about protection than performance. It's one most people never hear about until it's too late. Your 401k is better shielded from creditors than your IRA. Why? Because 401ks are protected under federal ERISA law. That means if you're sued or you go through a divorce or face financial hardship, your 401k is often off limits. It's considered a protected asset under federal rules. Raised? Not so lucky. They're protected under state law, and state law varies wildly. Some states offer robust protections, others not so much. I worked with a business owner a few years ago who was staring down a potential lawsuit, and we reviewed her financials and realized her 401k was one of her safest assets. And if she had rolled into an IRA the year before, she might have lost that protection entirely. Here's a SECURiMENT tip. If legal exposure is even a remote concern, whether from a business risk or a high liability profession or just general life uncertainty, don't rush to roll over your 401k. Keep it where ERISA has your back until you've weighed your option. This also applies if robbing a bank is on your bucket list. Truth number 9 is about the moment the IRS decides you've waited long enough. Once you hit age 73 or 75, depending on your birth year, the government says it's time to start withdrawing from your traditional retirement accounts. These are called RMDs, or required minimum distributions. They're not optimal. Morningstar found that RMDs increase average retirees' taxable income by more than 50%. That can push you into a higher tax bracket, raise your Medicare premiums, IRMA, and make more of your Social Security taxable. And here's the kicker. Many people don't need the money yet. They'd rather let it grow, but the IRS isn't asking. It's telling. So how do you get ahead of this? Well, one way is through Roth conversions in your 60s. And this is before RMDs are forced to begin. If you're converting some of your traditional 401k into a Roth, you're going to pay tax now, lock in today's rates, and potentially reduce future RMDs. And Roth IRAs, they don't have RMDs at all. So here's one reason to consider a Roth conversion. You expect to be in a similar or higher tax bracket in the future and want to reduce the RMD tax bite. One reason to wait and not do. You're currently in a high tax bracket, and converting now could trigger taxes at exactly the wrong time. Here's a SECURiMENT tip. Talk to a professional about modeling your future income and tax scenarios. The goal is not to avoid taxes, it's to pay them intentionally and in the lowest tax bracket possible. So here's the truth. A 401k can be an incredible tool, but only if you understand the rules, avoid the traps, and take advantage of the opportunities most people really never hear about. I hope now you know some of these rules. And if this was helpful, give it a like, subscribe, and share it with a friend or family members, anybody who has a 401k. So basically, anybody of working age. If you want a second opinion on your plan, your withdrawal strategy, taxes, and all that good stuff, head to theretirementguide.com to book a flat fee SECURiMENT review. There's no sales pitch, there's no pressure to buy something, just advice. If you like this video, you might like this one. And thanks so much for watching.